Hi everyone, Andrew here again. I've had a few conversations with people recently when we've been doing the review meetings or in between review meetings where we've discussed the poor short-term performance of their pensions and their ISAs and other investments. Um, and they've just been looking for a bit of um, reassurance that everything's going to be okay and the value of their pensions and investments aren't going to go to zero. So I thought it'd be worthwhile recording a video to share with you all. Some of you have been clients for a longer period of time and have been through previous downturns will hopefully be familiar with this. It'll be a useful refresher, I hope, anyway. And for those of you who haven't been clients for quite so long, this might be a helpful first introduction to an explanation of why markets go against us sometimes and what that might mean. So I'm going to take you through a few different screens. This first one is looking at data provided by EBI Portfolios Limited, who most of you will have your money invested with in some way, shape or form. And what this chart is showing us is looking at the past 5 years, so up from 2018, how different portfolios have formed with varying degrees of risk. So the red line here is a portfolio that is 100% invested in global stock markets. So right at the top end of the risk scale. Orange is a portfolio that's 50% in global stock markets and 50% in lower risk government bonds. And then the blue line is a portfolio that's entirely government bonds, so the very low risk end, and then the dashed line is inflation over the 5 years. So first thing to see is if you look at the orange and the red lines, how volatile it's been. This here is the COVID drop, the sudden drop in recovery we had during COVID. And then this here is the start of the energy crisis, war in Ukraine, and everything that's followed since. So you can see how volatile the equity based portfolios are, but how they have outperformed over the last 5 years. Certainly the red lines outperformed inflation. Um, they have outperformed low risk funds as well. And you can also see here when we had the big COVID um, drop in the equity markets and at the start of the energy crisis, you can see the bond portfolio did what we'd expect. It's given us, it's dampened that volatility, it's taken that risk away because we haven't got exposure to the riskier uh, global companies in the stock market. So investing in shares of various companies. So it's done its job there. But you can see as inflation has picked up, it's the lower risk portfolios that have done particularly poorly and worse than has been the case traditionally. And so I want to explain why that is. We've had this perfect storm over the past 24 months or so, where both the global stock markets and the bond markets, government bonds, have fared badly. And normally we'd expect them to work in opposite directions. Um, and we have a balanced portfolio, diverse portfolios. So if one part is doing particularly poorly, the other one should pop up and provide long-term returns. But it hasn't happened over the past 12, 24 months. That's not new. It has happened before. We just get these occurrences from time to time. So what I want to do now is give a bit more long-term uh, context, and then I'm going to give a hopefully a clear explainer on why we've had this the fall in the value of and the bond portfolios, the low risk portfolios. So what this looks at, if I just select the 50/50 portfolio here, and I'm going to go right back over, let's look at full range of returns. So we're going to go all the way back to 1956, 57. And we'll look at annual returns. So the dark purple up bars are all the years in which there's been a positive return in this portfolio. So a portfolio that's half invested in global stock markets, half in global government bonds. Now, the Big Earth portfolio was only created in 2019, so anything prior to 2019 is simulated data based on what would be expected had those portfolios existed all the way back in time. You can see here the down bars are lighter purple, are fewer and further apart, and when they've happened, they've generally been 1 years. You've got the odd couple of years here. We've had the 73, 74 crisis, which actually mirrors what's been happening over past 12 months, with particularly around Gaza and the Middle East, oil prices going up, high inflation, a lot of uncertainty. And so it was a difficult time for investment portfolios. But generally, the lows, when they're down, they're certainly not as low as the highs are high, if that makes sense. If we look at the average here, the average return of a portfolio over that time has been 10.5% a year. So very attractive and shows the longer you invest for, the greater return you can get. We have to expect these short downturns every now and then. What I want to show you here is um, a bit more context in terms of the annual returns. I want you to imagine, if you think back to the days before SatNav, when we had A to Z's road atlases to get us work out where we were going to get to, and in the back of those they had those mileage charts. So if you wanted to get from Exeter to London, you'd find out how many miles it was by reading across the matrix, or London to Manchester, wherever it might be. What this chart is doing is looking at annual returns over the next period of time. So had we invested in 1957 and sold in 1957, we'd have lost 4.6% of our money, 4.16% of our money in this 50/50 portfolio. 73, 74 I mentioned just now was a particularly bad time. You can see if we invested at the start of 1973 and sold in 1974, we'd have lost nearly 5.5%. So 1974 was a particularly bad year as well. So we had 2 years back to back with negative returns. But you can see in 1975 and 1976 were really strong years. So the things to pick out from this, if we go all the way through, is the absence of red in most single or 2 year periods. And the longer we invest for, there are absolutely no reds at all. There's no 3 year period or more in this portfolio where we'd had negative returns. And we can take this forward all the way to present day, and we can see it's much the same. Even during the great financial crash, the credit crunch in 0809, 08 was a bad year, and it was followed by a recovery. Although as painful as it felt at the time, in terms of stock market investing, it wasn't that bad for middle of the road investors. If we change it and look at what that meant for a 100% equity portfolio, we can see more red comes up because we're taking that more risk. In fact, 1969 through to 71 would have looked at a 3 year negative return, and 73, 74. So we had a few more periods of pain here, but then look at 75 and 76, 56 and 46% returns. So we're not really getting many more years of 4 years or more where we've had negative returns. And we go across to the credit crunch, and still, yeah, 2008, 2009 would have lost every 2 years. And also look here, so this is the 2001, 2003 period where we had the tech bubble bursting, followed by 9/11 and a second Iraq war. Very volatile time for global stock markets. And so investors then had a fair bit of pain, but you hold long enough, you're getting positive returns. So now if we look along the bottom row here, this is if we'd held our investments from every starting year all the way to the current year, you're looking at, for a higher risk investor, you're looking at 8, 9, 10% average return. Now we don't know what's going to happen. 23 is actually looking at like it might be a positive year for the stock markets. 24 onwards, we don't know what will happen. But if we use history as a guide, and of course that doesn't guarantee future performance, but over the long term, there's enough context to us to be optimistic. We will get the returns and we'll get the recoveries despite this short-term period of negative returns. And just to complete the picture, if we look at the bond portfolios, you can see much more certainty. There's just been that few periods, 94, we had a bit of a bond sell-off, but minor. It's just we've just from a historical context here, if we're 100% invested in low risk government bonds, we've experienced a fair bit of pain that we wouldn't have done previously. So with that, let me go on to explain best I can, hopefully, how bonds work and why we've experienced such a negative period over the past couple of years. So what this is looking at, excuse the very Janet and John approach to it. Um, we're going to take you through different parts of this. So we start on top left here with this picture of Jeremy Hunt, the present incumbent at number 11, the Chancellor of Exchequer. Now, if you're the Chancellor and you want to raise money to fund things like infrastructure projects or fund the NHS or schools or pay for the top up to energy bills for the energy crisis, fund COVID recoveries, whatever it might be, you either tax a population more, which doesn't win you too many votes, and actually there's a rule that says that actually the higher the tax rates are, the lower the actual tax take. So it doesn't work just to keep raising taxes. The actual revenue generated anyway. So the other option is to borrow money. And so when you hear about the cost of borrowing or government indebtedness, that's the government borrowing from investors like you and I in our pensions and ISAs, the large public sector pension funds, institutional investors around the world, and these sovereign wealth funds um, from the Middle East and Far East and America. That's investors around the world lending money to the British government in exchange for uh, payment of interest and in their money back at the end of the term. So thinking about it, like you and I having a mortgage, we'd go to the mortgage provider and they'd look at our financial security, our um, credit worthiness, uh, and offer us a particular interest rate, and we'd have to pay the interest back every year and pay it back at the end of that term, pay off our mortgage at the end of the term. And so it works very similarly for governments around the world. And if we look at this table here, this is the current 10-year bond yield. So this is governments around the world borrowing money for 10 years. And it just shows you that as you or I as individuals, we have different levels of credit rating. And also the amount we can borrow at will vary. If we want to borrow a mortgage and we've got a good credit rating, we borrow at a lower interest rate than someone who's looking for a payday loan to see them through to the next payday. So you can see here that Japanese government actually a very low level of yield. So interest rate they have to pay, yield, one and the same thing on their 10-year debt. Look, UK here, we're currently having to borrow at 4.2%. So the yield or the interest rate that the government is borrowing at currently on 10-year debt is 4.2%. If you're the Turkish government, look, you've got to borrow at 26%, a yield of 26, which just shows at different levels of credit worthiness across governments around the world. So the government, the investors around the world borrow money and they get it interest rate, a yield paid until the end of the term. But within our pension and ISA funds, these bonds are traded on a daily basis to try and generate some return as well. And that's fine until we have an inflation crisis and cost of living crisis, and the Bank of England has to step in to try and bring inflation down as much as possible and as quickly as possible. So they therefore raise interest rates to reduce our disposable income, so we're not going out and spending money to push up inflation further. They want the cost of goods to come down, so they push up the cost of borrowing, and that applies to the government as well. So for new issues for the government, and these figures are for an example here, but let's say it's 4%, which is close to 4.2 here. Investors can now get 4% and not 2% on the debt. So suddenly, as an investor, it's looking more attractive to have new government bond issues. And the way the relationship between the yield, the interest on government bonds, and the price, the return works is they're working in inverse. So as the yield goes up, that interest goes up, the price that you can get in the market for it if you trade, you'll try and sell your bond issues. If you're a fund manager, you want to try and sell your issues, the price you get falls. So yield goes up, price goes down. And that's simple economics. If there's less demand for a good or a service or commodity, the price of it goes down, which is why anyone holding issue where they're only getting 2% interest rate is seen that the value of their investments have fallen because it's suddenly less attractive. There's no buyers of that particular bond issue, so the price of it falls. So just to give you some historical context here, this is what's happened to British government bonds, UK 10-year bonds over the past 25 years or so. You can see in the early 2000s, when interest rates were previous at the previous levels they are now, you can see yields are pretty high. So government borrowing at pretty high rates around between 4 and 6%. Then we had the credit crunch, and all of a sudden the yields fell, and they fell significantly and consistently over the next 10 to 12 years as the Bank of England base rates fell to those historic lows, and they kept falling with the idea to get through the period of the poor economic time that we had post credit crunch. So interest rates were very low, trying to get people to spend, and they stayed very low for that long period of time, which was fine for government bond investors, as we saw that they were doing what they wanted and we expected them to do. Then we get to 21, 22, and the start of the war in Ukraine and the inflation crisis, the energy crisis, and then we've experienced Bank of England have put interest rates up, which, as I explained on the previous slide, has a negative effect for government bond investors. And then we had this sudden dramatic week here when Kwasi Kwarteng and Liz Truss had their little moment and thought they could have a really benign tax environment without getting it corrupted by the Office for Budget Responsibility. And the market said, hold on, we don't know how you're going to fund this low tax environment. Therefore, we're going to perceive you to be of a weaker financial strength than we previously thought. And therefore, the rate at which you must borrow money at must go up. The yield goes up. And therefore, as we saw earlier, the price goes down. And that's why it was suddenly we had this catastrophe, and big pension funds around the country were suddenly having suddenly had to be rescued, and we had to take Bank of England had to take dramatic effects, unwind the mess that Kwasi Kwarteng and Liz Truss created. So that's just to provide a bit of historical context. So we don't know what's going to happen next. As of recording today, they've just announced inflation figures have fallen further. Bank of England have previously said that the current rates of interest may stay current rates for next 12, maybe 24 months. So I don't expect prices to change dramatically over the next few months, 12, 24 months, but we should hopefully have seen the peak in interest, in inflation, peak in interest rates, and therefore the lower risk elements of our portfolios may then start to recover. So I hope that's a helpful explanation. If you've got any questions on it, let me know. But if you have been a bit nervous and a bit unsure about what's been happening with your portfolios, hopefully that's provided a bit of an explanation there for you. Thanks for listening.